When you're in second, it just means you're the first to lose. I don't think there's that much more risk in a second position mortgage than there is a first. So we have a 20 to 30% buffer every year. That's what protects us. You can be sloppy in it. It can be your first ever private mortgage. You do a lot of things wrong and the collateral should still protect you. Why wouldn't you be okay to lend 100 behind 700?
In a depreciation scenario, the vulnerability is different.
Okay, in a sense, you're correct. Meaning, okay, so what is the difference between first and second mortgages and what role do they play in a retirement portfolio? That's what we want to talk about today, Nick.
I'm assuming the further you are in your journey, your life journey, the more you're leaning towards first. Is that like a good rule of thumb, or do seconds just not have a place at all?
Well, let's talk in terms of the two things that matter the most: risk and return. Okay, so in terms of first and second mortgages, if you're in first position, you are taking less risk. And I'm going to explain exactly what that is because a lot of times it gets misinterpreted. People overestimate, in my opinion, how much riskier a second position mortgage is than a first. I don't think there's that much more risk in a second position mortgage than there is a first. On the return side, though, I would say the difference is a little more dramatic. You get a much better premium return by being in second position. In fact, I would say it's a disproportionate premium for being in second position. And again, once you understand the risk piece, I think my comment that it's a disproportionate premium to be in second position will make more sense. So I'm going to start there. We're going to talk about the risk first. Look, the easiest way to understand this is, and we will get to how it fits in a retirement portfolio. It'll bring a lot of context. So if you look at, I come to you and I say, hey, listen, let's just say you're a very wealthy person and you've got the means, and for easy math, my house is worth $1 million. I'm looking for 800,000. If you do your due diligence and you determine that you feel comfortable lending 800,000 against that $1 million property in first position, can you think of a good reason why you wouldn't lend 100,000 behind 700 against the same million? So, meaning there's a 700,000 first, and you're going to put 100 in behind it and second. The total of the two mortgages is 800.
Yeah.
And you were okay lending 800, all of it. Like you were okay to lend it all.
Mm-hmm.
Why wouldn't you be okay to lend 100 behind 700?
In a depreciation scenario, the vulnerability is different.
Okay. In a sense, you're correct. Meaning you're the first to lose.
Yes. Your chunk is the first to go.
Right. But it's important to put perspective on and context around how that plays out. If you go into this basically sure you're not going to lose, like you can't see a scenario where this house sells for less than enough to pay out the full 800 plus interest, you're okay being in second position to the same LTV, same loan to value is 80%.
Yeah.
Now, the risk though is different. And the risk is different, not in the way I think a lot of people assume. It's just automatically riskier because you're in second. The risk is that if I put in 100,000 and I'm the last 100 in and the last 100 out, a $50,000 loss represents 50% of my investment.
Right. Your chunk gets eroded way more quicker.
Correct. Whereas if I lend the whole 800 in first position and 50,000 is lost, I've only lost 1/16 of my money.
Right.
That's the difference in risk. But if you were now let's play this differently. Now I come to you and I say, hey, Nick, I'm looking at this deal. I'm going to go in. It's a great deal. It's $1 million property. They only need $600,000. But I only have 500. Would you put the other 100 in second?
At 60 LTV?
Yeah.
Oh, then the feeling is much fuzzier.
Not only is it much fuzzier, let's flip the script now to the return side. I'm going to get, 7%. You're going to get like 10.
Right.
Why? You're still at 60% loan to value, but the cheapest second mortgage out there is not cheap.
Mm-hmm.
You're going to pick up a disproportionate premium to your risk in that scenario. Would you agree?
Yes, 100%.
So at 80% loan to value, second position, as you put it, isn't as cozy. At 60 or 70% loan to value, if you pick up a second position mortgage, you're going to get still that disproportionate premium and you're going to be much cozier. So that leads us into the question of tonight, which is what role do they play in a retirement portfolio? Well, you might agree now that we've broken it down that way that it really depends on which second position mortgage you choose. So if you're fortunate enough to find the second scenario, and they're not out there in abundance, then you're gonna love second position mortgages.
Yes. 100%.
If all you can find is 80% loan to value second mortgages, you're gonna have to pick and choose very carefully.
And this is where you've said in the past you focus way more on the borrower.
Focus on the borrower. Now, here's a really interesting piece of this. So now you meet someone like me who runs Magnetic, and Magnetic is a syndicator, which means we can put investors together in different mortgages. We can split mortgages up, break them into different pieces, and so on and so forth. Well, imagine that we lend somebody 75% of the value of their house as a first mortgage, but then split that mortgage into two pieces behind the scenes. The borrower pays one price, they get one first mortgage. But there's a mechanism by which we can split that mortgage into two pieces and feed different appetites. So we can create a first mortgage at a very, as you said, cozy, loan to value, say 50%. And we can give that to a retiree who, you might agree, values security probably more than return at this stage in their life.
Right, I see.
And I can say to that person, okay, tell you what, I'm going to give you the cozy piece, right? I'm going to give you priority, meaning you get your money out first and you lose last. But you're not going to make what we're charging the borrower. We're charging the borrower, let's say 9% or 8%. You're going to make 6%.
Because they wanted safety. Yeah.
And you're going to get a premium in safety. And then I come to you, Nick, and I say, listen, are you comfortable at 75% of the value here? Okay.
Yes.
Well, I'm going to give you a lift. So I'm going to take some of the interest that first piece is earning, and I'm going to give it to the back piece. Now you're going to occupy the second position, the B position. You're going to be subordinate to the first, but we're all cozy. Everybody's happy at 75%, but we're giving almost a bit of a guarantee to the front piece, right? We're not giving a guarantee. We're not allowed to give a guarantee, but we're giving a much cozier position, just a premium on security in return for a premium on the return on investment. And we can feed both mouths. So our younger investors who are in their money-making years and are looking for a little more yield can get it without taking additional risk. And our aging clientele who is retiring and is in preservation mode, right, can get that premium security. And this is the magic of administration.
Yeah, this is it seems almost like you're literally creating different risk profiles within the same vehicle.
That's correct. So you're taking the total yield you can get from a borrower, and you're able to
shift it around.
break it. Yeah, you break it and shift it around to sort of shift risk to one side and return to the other, or risk and return to the same side.
So I guess the one in terms of like the role they play in a retirement portfolio, I guess that's determined when you have a sit down with an initial investor and they have a certain goal in mind for retirement. And to get there, you got to sprinkle in some extra yield. Would that be fair to say?
I think this is the magic of private mortgages when it comes to this type of thing. We have so much more flexibility as an administrator and an experienced one who understands the ins and outs of how to move, break yield up and spread it, shift risk and whatnot. You can't really do this in other investments, right? It's like, it is what it is. You took the risk and that's it.
Okay, give me the riskier version of Apple.
but yeah, but for us, we can really customize someone's portfolio and continue to adjust the customization as they age or as their circumstances change. And so for someone who, maybe doesn't have as big of a nest egg in their retirement years, does want the security and is in preservation mode, but still needs a little extra yield in order to pay the bills, that can be achieved.
Gotcha.
Right. So it's a matter of the mix between first and second mortgages, or A and B positions in our case. What's really hard to find is someone looking for a second mortgage at 60 or 65% of the value of their house, because if they need that, they can usually get it from a bank.
Yeah, it's like these really, really fringe cases. I remember you had found one for me where I was in second position, but the LTV was like sub 50 or something, some kind of dispute between siblings.
They do come along. Yeah, they do come along, but they're rare. But using the mechanisms of administration, we are able to create those opportunities from a larger first mortgage, right? So a higher LTV, 75%, even up to 80, and we can break that into two pieces and create those front end very highly secured pieces that are coveted by our retirees. Because typically we have two. I mean, I'm oversimplifying, but there are essentially two types of clientele that we service. One being the retiree, so someone who's past their money making years and is really looking for security, flexibility, consistency, predictability, those types of things. Maybe they're jet setters traveling around the world and just need to know a check is going in there every month and so on. And then you have the other sector, which is essentially people in their money making years, right? And who don't we service as much is younger population that hasn't built equity yet, doesn't built the nest egg. And those people are doing right, in my estimation, to use leverage to their ability, to their advantage, meaning buying the real estate and having it appreciate and so on until they can sell it and cash out and have a chunk of money that they can now become the bank and lend. So you're almost waiting for those people who are landlords in their 30s and 40s to maybe get a little tired of that and want to abandon landlording for lending.
You're waiting for life's headaches to take them over.
yeah, essentially. So
I got there earlier than I thought.
Yeah, and I mean, and that's really basically it. I mean, I think the fundamental understanding that I want to communicate in this episode is just to understand that nobody needs to be afraid of second position. You just need to understand the relationship between first and second position, and understand that inherently there is more risk or more risk factors being in a subordinate position in the capital stack, being in second or third. But it's really all relative. The amount of risk or additional risk you're taking is relative to the loan to value ratio, right? So how highly leveraged are you? And I think it's important to have an understanding that when you're in second, it just means you're the first to lose.
Yeah.
It doesn't mean the mortgage itself is riskier. It just means in the worst case scenario, you're the first to lose. You're the last in, last out.
The mortgage itself is huge. Like, I know you've talked about other markets. I don't know if you would agree that Thunder Bay is one, or one of those markets where prices are kind of more stable. Second position over there on a detached house feels much different than second position in like a GTA condo right now or something like that.
Yeah, I mean, listen, the market is always changing. Individual markets are always changing. You've heard me say it a million times. We're always looking for neutral markets, right? We're looking for markets that don't appreciate too quickly in good times and don't depreciate quickly in bad times. Now, you might look at me and say, why would you want to be in a market that doesn't appreciate quickly? Well, it's not that we're not looking for markets where there's appreciation, but in a market that appreciates dramatically over a short period of time, the reverse is also true. When things aren't great, those markets will depreciate just as quickly as they appreciated.
For sure.
So, it's neutral is great as a lender. If you're a buyer, you're looking for those markets that appreciate, try to time the market, get in when there's an opportunity, like right now, right? Like if you were to buy a condo in the GTA right now, I'd say, we're close to the bottom. So you're likely, if you buy and hold now, probably 5-10 years from now, you're probably happy with that purchase. But similarly, I mean, we lend on a 1-year cycle, right? So
that's the other difference. Yeah.
You on a 1-year cycle where, I mean, if you step back right now and you go, look at what's happened to housing prices since 2022 or 23, you go, oh my gosh, it's like 30%. But amortized over 3 years, it's 10%, a year. And so for us, we have a 20 to 30% buffer every year. That's what protects us. So, so yeah, what I don't want is for people to, approach second mortgages as with fear.
Yeah, it's not as cut and dry as first good, second bad.
It's not.
There's an entire backdrop to these instruments.
Pros and cons, case by case, right? Evaluate each scenario individually. I mean, I think that's the advantage of having an administrator work for you. You can do this all yourself. But having somebody who's doing it all day, every day, seeing thousands of applications, dealing and managing 100, 200, 300 mortgages a year, right? You get a feel. You get a feel for where to be in second position and when not to be, when to trim the LTV just a little. I mean, somebody applies for 77, 78% loan to value, 80%, and you're able to provide a solution that has a solid exit strategy. The borrower's ability to pay is there, and you're able to lend even a few percentage points less, 76, 75. Right? These are all mechanisms and levers that make you a more sophisticated, stronger lender. Look, inherently, I say this all the time, the space is great. The lending space is great. So you can be sloppy in it. It can be your first ever private mortgage. You do a lot of things wrong and the collateral should still protect you. But over time, what is going to happen is that you do enough of these, at some point, you may end up on a landmine, right? And by landmine, what we consider to be a landmine is something where it looked one way when we took it on, but something happened that was unpredictable or unexpected. And then you need to be very skilled at solutioning and understanding how to leverage your collateral and time to get through it. And usually there's a way out. It's just a matter of finding it and doing the work to find it. And that's where you can, really benefit from guidance and experience from a group that does it every day.
Okay.
Don't be afraid of second mortgages. You've done very well in seconds.
Oh, they were all at one point, before I knew about, the time cost of money, they were all I wanted.
Yeah, exactly. Yeah. All right. Well, until next time.
Happy lending.
Bye-bye. Yeah.